Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Inflation, we've been talking about it. It's coming, nothing you can do about it, but you can't sit still either. So we're going to dig into what you can do as we get through this inflation wave. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Okay, Bob, how do we fight this inflation monster?
Hey, Phil, what we have here is embedded inflation. So this isn't your normal like price rise kind of environment. This is going to be geometric in nature, and it's going to be long term. And so you do use the same formula to outrun inflation like you did in the past. The rule of thumb is inflation's X%, stocks go up average 11.8% a year, you're going to outrun inflation at this point. That's not what happens in an embedded inflationary environment. As we were showing you guys before, your price multiples, which means the price at which they're willing to give on the earnings falls during an inflationary environment. And people tend to, will move out of the stock market. And at the same time, bonds are no help to you because yields are going up to try to get in front of the inflation monster. So you kind of get in a lose-lose situation. And I just want to show you, if you just sat still, what your portfolio would look like over time. And the thing that's really getting me nervous is I'm hearing the talk now the Fed's going to go walk away from the 2% inflation mantra to the 3% inflation mantra. And you get to see how much more of your lifestyle gets eroded away. Look, make no mistake about it. The government's going to keep spending, and you're paying for it. They can't raise your taxes anymore because that's too obvious to people. They're going to tax you through inflation. And basically, it's going to drive most of the country into third world status. I don't even know what the rest of the world's going to look like. It's going to look pretty grim, Phil.
Yep.
And in this environment, you're like, okay, so now what do I do? Well, this is how most people are positioned right now, this next chart. This is called the Model 60/40 portfolio. This is anybody that's getting their money professionally managed is on some derivation of this, unless you're in there telling your broker or your RIA or your financial advisor to modify this in some way, shape, or form. Now, when you have a deflationary environment, which we had in the 1930s, and we had a little bit in 2008, stocks and this portfolio falls. But it really does not like inflation because, like I said, multiple compression and bonds lose money at the same time. We got a taste of that in 2022, and it's going to raise its ugly head again, Phil. So the situation that we have now is that, and you've been talking about this with the TGA, the Treasury government checkbook, is that as soon as they come to some sort of resolution on the debt ceiling, is that the government is full steam ahead on spending, and they're going to refill the checking account because they're going to be able to borrow again. That's going to drive the 10-year yield higher. When it does that, we're going to be in the same situation we were in 2022, but this time inflation's already embedded. So you're going to get in a situation where everybody's like, oh, good, they're going to pause, and the government's going to be able to spend again, and we're going to get this impulse in economic activity, but it's not going to be able to beat inflation. And GDP is falling behind inflation. And then that's when all the things that we talk about, Phil, are going to come to the forefront. That's where you want to own the commodities, where you're going to want to own Bitcoin, and within the commodities, you're talking about, gold, silver, platinum, coal, uranium, et cetera, et cetera. And this next chart I want to show you because China's reopening, and look what China is getting ready for. And they've already started their credit impulse, Phil. And credit impulse is that they're letting their companies borrow money again. Our prices follow that credit impulse. So this is why we've been talking about, hey, at some point, the commodity wave is going to rip because we follow this impulse by about 6 months, and we're at the bottom of that impulse now. It really ended with the Chinese New Year beginning, and you started seeing it. Uranium started to move, coal started to move. You got a bottom in oil and energy, and steel stocks started to move. And so we're ready for this impulse higher, which means commodity prices are going to rip. At first, it may help stock prices because everybody's going to say, all right, economic activity is going to rise. But once that inflation wave from the Chinese manufacturing comes in, then it's going to be a nightmare. And this next chart shows you China's gearing up for something big, Phil. Look at this. Look how many coal plants they're bringing online.
Yeah.
And how many nuke plants they're bringing online.
Yeah.
China's getting ready for a major, major, major lift in their economic activity. And, to beat a dead horse, that's inflationary. Your thoughts?
I think you touched on an important point, and that's the TG. I agree with all points, and I agree that the energy side of things is long term going to probably outperform most. Aside from maybe Bitcoin, just because of how finite it is. But most people are looking for diversification, and that's definitely got to be part of your diversification in your portfolio is energy. I think you touched on an important point with the TGA balance. See, most people don't realize that Yellen can't drive that up because she's maxed out on her debt ceiling. So the government can function for the time being, but she has $350 billion left in that, and then it goes to zero. And when it goes to zero, national parks can't run, nothing can run, okay? And sure, there's some fluctuations in here and there with quarterly tax receipts and things like that, but by and large, we're running at such a large deficit that at the rate of descent on that chart, if you look at her balance sheet, the checking account balance at the rate that it's going down, we're at zero either by the end of this month or the first part of April, all things being equal, even with receipts coming in, tax receipts coming in. So then you have a situation where as soon as the debt ceiling passes, okay, whatever the fight is that comes, and they talked about, doing this in June. They may have to address this sooner than June, but all the headlines, this is going to become front and center, getting this debt ceiling limit raised. And the minute that happens, it's going to be negative equities. It's going to be negative risk on, and people don't realize that. So, you think, oh, yay, debt ceiling's raised. But in our current situation where she's basically going to be running out of money, it's going to put us in the same situation we were in the beginning of 2022, where she was running on fumes again. I think we had that debt ceiling argument back then or thereabouts. And then she drove the treasury account balance straight up in the air because she was issuing debt. And the whole time the stock market fell. So we're going to have major, major headwinds in the second half of this quarter, or second half of this year, I should say. You've got inflation compounding that worse this time around. And we're already down, and the yield curve's more inverted than it was. So I think there's a false sense of security with the bounces that we're getting, these 1, 2, 3 day bounces in this market. Again, I think like we pounded on yesterday, I think it's just false hope of lower highs ultimately. And you have to be very careful here not to get lulled into sleep. And then next thing you know, you're down another 30, 40, 50% in your portfolio as we go into like Q4 of this year.
Yeah. And I think the politics too, the dollar falls in these environments, so that's going to it's also the impetus to a lift, and you can hear it now. China's really starting to squawk and scream about this, as well as other countries. And I saw some comments yesterday that probably said you guys are too macro. We talk macro, we trade micro. There's plenty of opportunities. Things were going down yesterday and things were going up when things are going down in the broader market too. We just look for opportunities. Yesterday was stellar for natural gas. Okay, energy held up, gold miners were up. So, we're just talking macro here because we don't know anybody's personal portfolio, and this podcast isn't a trading site. If it was a trading site, we'd have a whole different conversation going on here. We're just trying to warn you to get in the right cruise ship, okay? So you're not going to cruise to hell, because this is not going to be your normal economic lift kind of event here. It's really going to be punishing because prices are outracing people's ability to pay for things. And you're going to want to be in the things that are going to move up with this inflation. And you just have to look at what's happening in the consumer stocks. They're just getting obliterated. And we're just trying to wave that flag for you guys. But absolutely, there's tremendous opportunities within this. We see them every day. And if you guys want to trade with us, then you come in with us and you can see what we do. But from a macro standpoint I think they're opting for the no landing fill. And I think they're going to rue that day when that thing really embeds.
Yep, I agree. Yeah, so probably let's talk about the government checking account and how that performs against the market, because I think that's going to become front and center here over the next few weeks, and it's going to dominate the headlines as we go forward into summer.
Absolutely.
Cool, guys. Well, thanks for watching. Please hit like and subscribe, smash that notification bell, and set it to notify for all if you could. And also check out our specials on, we really would love to see you in the room with us. And that's where we get down into the nitty gritty, trade the intraday and daily and weekly swings on some of these stock plays. If that's what you're looking for, that's where you can find those. All right, guys, thanks for watching. We'll see you on the next episode. Take care.
Trade Genius.